And since we are not going down in the CPI, then I don't believe the Fed will be able to cut at all until it is forced to by a financial crisis. And it is that final crisis that will cause the final slingshot in the gold and silver markets. And at that point, we will not be able to get in anymore. And in my humble opinion, the final rally in the real money metals will be so intense that it will scare even those of us that are true believers, because we'll know what's going on and we'll know what happens to society when gold and silver can no longer be exchanged back into the local derivative anymore.
The gold market is struggling as expectations for the start of the Federal Reserve's easing cycle continue to be pushed back. However, according to one market strategist, the longer the central bank waits, the greater the risk of a policy mistake, which could ultimately be positive for the precious metal. A notable financial analyst, Rafi Farber, questions the Fed's capacity to cut rates without an economic crisis, which he believes would trigger a significant upswing in gold and silver markets. Time will ultimately reveal the outcome, but one undeniable fact stands. The bigger the rate cut, the bigger the rally in precious metals. If history is anything to go by, then gold's record-breaking performance last year could be a taster of what is yet to come in 2024. That's welcoming news for the bulls, but painful for anyone sitting on the sidelines, who must now decide how much FOMO they can handle. Meanwhile, Farber observes historical inflation while drawing parallels between the intense second waves in the 1940s and 1970s. He thinks a similar pattern might happen now, making recent low CPI as expected in complex systems. During the 1973 to 2021 timeframe, the average inflation rate was 7.4% across periods of high inflation. Over those periods, precious metals returned, in nominal terms, 7.9%, and in real terms, 0.5%. If we are due a period of structurally higher inflation, gold is a potentially attractive asset class. Furthermore, Farber envisions a positive outlook, anticipating an economic upturn and a breakthrough in the gold market if it breaks the triangle pattern. This optimism resonates with Main Street sentiments, as reflected in the Kitco News Weekly Gold Survey, indicating a balanced yet predominantly bullish stance heading into the final week of February. Concurrently, Wall Street analysts abandoned the bear cave to gear up for another projected bull run. Now, we present the clips of Rafi Farber's insights from his recent video with Arcadia Economics. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Gold. Gold is in a situation it has not been since late 2018, when it began a nearly 100% rally from late 2018 to August 2020. 53.6% of the total COMEX gold stockpiles have been drained out since Silver Squeeze, and twice that, more than twice that amount has been squeezed out of all gold funds since Silver Squeeze. Gold in $1959 in uninflated dollars is still $42.22, and I'll show you the chart that one of my subscribers cooked up for me, a physicist actually, shows that in uninflated dollars, if you take out the actual inflationary factor, gold is still what it is statutorily at $42.22. People have been making a big deal about long-term rates lately, but if you look at long-term rates, 10-year rates, treasury rates from 2020 to now, you'll see that we've just been bouncing off. The 50-week moving average is very similar to what we saw in the late 1970s, when after the final bounce, we headed vertical to about a 20% interest rate. I'm going to show you two times in the past, once in the 1940s and once in the 1970s, where we had two price inflationary waves, what they call inflation, what I call rising prices, two waves of rising consumer prices. The second wave was always more intense than the first, and there was a 24-month lull in those two periods in the 1940s and 1970s, and we could be going through the same thing now. The fact that there has been a lull in consumer price inflation is not an anomaly. It is normal when you're dealing with complex systems like this. This is a chart that was given to me, that was configured for me by a longtime subscriber to the Endgame Investor, a genius man, a physicist, and he was able to calculate gold's price in $1959. I don't believe in the accuracy of filtering out inflation from all types of consumer goods, because inflation affects different things differently in different proportions, but I do believe you can filter it out of money itself, because it is the money itself that's being inflated. It's the money supply, the currency as a gold derivative, that is being inflated. So if you take out the inflation from gold itself, this is on a scale of 1959 normalized dollars, gold ounces in dollar terms. So we see here that usually this is the $35 mark. This is where FDR put gold in 1933, or his treasury guys, or whoever it was. And every so often it does get out of control. So we saw here that gold in real terms launched to $250 an ounce above the $35 an ounce mark that it was in 1933. After that, the Fed got control of the market again, and because of high interest rates that were in principle payable back in 1980 that are not payable now, not even close, this triangle started to descend, and we went back towards the $35 line. And by 1997, we went below it even in 2000. So in real terms, gold was below $35 from around 2000 to 2006. And then we had the 2008 financial crisis, and then the 2011 top here, which established our triangle. And here, we can see here that this is where we are now, and we're just about to touch the triangle here again. If we go to the next chart, we can get a close-up of what's going on, where gold is in real terms in $1959. And look at that. The last data point we have was the beginning of 2024, and we were at about $42.22, which is where Nixon left it off in 1973 after he gave up trying to repeg the dollar to gold in that year. We are now in year 51, or year 50. Year 51 will be in August 1973, I believe. We're in the Jubilee. I hope this will be the last year. We'll see what happens. This can be excruciating, but it is logically, it must happen. So we'll see if we can get above. This is the triangle line. If we can break through this, we can break through this 1980 triangle and really get to scary heights in the gold, and by extension, of course, the silver market, which will become unhinged from gold and approach a 15-to-1 ratio.
Over the last 3 years, 53.6% of the physical gold supply has been depleted, amounting to 21.26 million ounces. Rafi Farber sees it as a race between central banks and private stackers, expecting more gold depletion soon. Gold has seen 10 straight months of outflows from the COMEX vaults. February 2023 has had 500,000 ounces leave the vault month to date, following a 900,000 exodus seen in January. The daily outflows have picked back up again after a relatively slow December, where only 200,000 ounces left the vault in the net. Since January 20th, there have been 9 days where more than 75,000 ounces were taken out of the COMEX vaults. In the current gold market scenario, Farber relates the situation to 2018, marked by a significant drop in open interest. This suggests a potential setup for a strong rally in gold, following historical patterns. Let's get back to the interview.
Here are the calculations I made. In the last 3 years, we filled 21.26 million ounces. This is eligible and registered, all the physical gold. This is the actual stuff that's in the vaults. So 53.6% of the supply has been drained out. That's over half in the last 3 years. In the last 22 months, it was about 50%. So half in 22 months at this rate. In the next 22 months, it's empty. I don't know what exactly is going to happen, because we've been saying that for a long time, but this is just for tracking. So in the last 9 months, we've drained 5 million ounces. That's 21%. In the last 2 months, it's been 2.6 million ounces. So this has been a very quick, very fast drain here. Since around December 2023, the last 2.5 months or so, the drain in gold continues. And it's not just in the COMEX, it's across all funds. See here, the blue line, this is across all transparent gold funds. We have fallen about 45 million ounces since silver squeezed that line over here. And if you take COMEX as part of this, COMEX is responsible for about half of it, for 21.26 million ounces, or a little bit less than half. But it's not just COMEX. Gold is being drained from all paper funds. I think it's going into a combination of central banks and private stackers. It's a race between the central banks and us. I don't want them to win, and they won't win because they'll have to sell their gold anyway when their currencies collapse, which is close at hand. In the gold futures market, we haven't seen this since late 2018, and before that, we haven't seen it at all during the current gold bull market that began in late December 2015. So this I went over briefly last week. We're going to go over it again because open interest has fallen even further since last week, putting us in a situation where we haven't been since late 2018. If you look here, it's hard to see here, but focus in a little bit if you can see it. You see here in this rectangle, this is back when open interest, the number of contracts open on the COMEX, was where we are now, 407,000. I think it's like 408,000 now. It's something very, very close to this. This is one day delay, 2 days by the time you're seeing this. So here we have, I think this is open interest of exactly 400,000 in late 2018, if I zoomed in on a different chart. But you'll see here a little bit of a sell-off in gold in around November 2019 with this little sell-off and this little bottom over here that led to a giant waterfall decline in open contracts, and we hit that 400,000 level. So a minor sell-off leads to a big closing of contracts, waterfall, and we have a low here. And from that point, we were just below 1200 and we hit a high of about 2100, just below 2100, let's say 2090. So that's about 100% move. It's a little bit less, but the point is, once you have open interest numbers this low in a bull market, it signals a lot of fuel for a very big rally. And this was the biggest rally we have had in this bull market, the biggest, longest, and most sustained, about 100%. I don't know when this rally exactly is going to begin, but we have the fuel for it to last long when it does. And we will see how much lower we can go in open interest. But we see that the low open interest, these contracts closing has not affected price that much. We have a very brief rally here from 2000 in the last few weeks. You can see at the end of this chart, and open interest has just fallen since then. So we might be at a bottom of price by about $2,000 here. Could be the floor. I don't know for sure, but this looks to be very strong. Potential rally coming. When it begins is another question, but the fuel is definitely there, judging by these open interest numbers. That means very, very low interest in gold derivatives. Why is that? I believe it is because the demand for dollars is going higher as the final financial crisis, dollar crunch, comes upon us.
The main driver of old price optimism is the expectation of rate cuts. However, many other factors could contribute to higher gold prices, including a falling dollar, geopolitical tensions, and central bank buying. It's time to listen when all the crystal balls say the same thing. As we look ahead, will the above narrative lead to a pivotal moment in the gold market, shaping its course in unforeseen ways? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.